Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. Since late March, possibly mid-February, two patterns caught the mood of this market, with a third one developing that now seemingly no longer is appropriate. The first was the previously mentioned mid-February to early May pink descending triangle pattern type, which we finished with in early May. It's not a perfect pattern by any means, however the pink upper trend line, though previously breached, did show merit, and the flattish pink lower trend line, currently at 539, did hold up the market, though it gave way in late April. Yet with changeover I've been forced to rethink this. More on this shortly. The second pattern still utilises the pink lower trend line, but instead is a smaller pattern and dates from mid-March to this week, with a bright red upper trend line, currently at 545. This had a break on the downside at the end of April with the changeover. Prices have found themselves initially back within this descending triangle, and this week breaking higher out of it. Finally, there is the unhighlighted mid-March to mid-April bearish shift pitchfork, with prices this week pushing up and over the upper time, currently at 539. And I am now set to consider retiring this by next week. All three are bearish patterns, the last one especially, and earlier gave some potential targets below for the first larger pink descending triangle of a primary target X in the 490 zone, with a secondary harder to reach target X1 down in the 471 zone. I said 3 weeks ago that, and I quote, "I'm not too sure about these two, but for now they will do," end of quote. I approached them in the same way last week, and the reason why was because I suspected there was and is some pretty good support below, specifically the not too far away 38.2% absolute Fibonacci line at 521. This held up the market effectively back in August last year, and though pierced last week, prices did not stabilise below it, even before changeover. With the subsequent moves higher last week and this week, I am now considering retiring both the primary target X and the secondary target X1 as we go forward. You see, I said last week, and I quote, "On the top side I'd watch the bright red downtrend as well as all the moving averages and the December 2020 low at 566, end of quote. And this is where we have seen prices get bogged down this week. The December 2020 low at 566 plus the flatlining mauve medium moving average at 559, and especially the flatlining gold long moving average currently at 567. Beyond these, we have some clear air overhead until the congestion of 588 and the March 2021 low at 592. Overall, this is the second break from these triangles, and I still cannot get out of my mind that having advanced so far along these triangles, that we might be handed here a double bluff with a second possible false break. I would be very cautious about this break high because of that, and wait maybe another week, maybe 2 weeks to see the strength of this move higher. As so far it seems the mauve medium moving average and the gold long moving average are capping prices. Chicago corn. A major move was seen here at the end of February and going into March. The end of the upwards move we'd seen since the start of the year, and a quite sharp move lower. At the same time I said, and I quote, "This all raises the question as to whether we have potential here for a further bearish halfway hesitation or a double bottom," end of quote. I even back then laid out some potential targets below for such a move lower, but these turned out to be wrong and I have retired them all. Instead, the market followed the path for a double bottom with a primary target X at 497 and a secondary target X2 at 504. 3 weeks ago we reached the target X at 497, but immediately pulled away lower. This put on hold the secondary harder to reach target X2 up at 504. Looking at prices now, well, let's just say that the primary target X at 497 was enough on the top side. and I've retired the secondary hardest reach target X1 up at 504. Instead, last week I drew a mid-February to mid-April bearish Andrews picture, which, whilst not being exact, as the upper time, currently at 440, has been breached on a number of occasions, this upper time still nevertheless shows the bearish angle of attack. For now, I have chosen this steeper bearish Andrews pitchfork over the shallower bearish shift pitchfork, as I think it gives a more suitable representation of the way the market is moving lower. However, and it is important however, and I quote from last week, however, that being said, whilst it's not represented here, the time's next crossover this coming Monday the 19th of May. So watch out for one or more of the following then: a change in trend, a reinforcement of a trend, volatility. Coincidentally, after changeover this week, prices are now testing the 50% absolute Fibonacci line at 425. So it's worth being cautious right now. End of quote. The caution was well rewarded, as this past Monday the 19th we had a combined key reversal up, if only just, plus a bullish engulfing pattern and a bullish opening white Mariposa. And prices since last Friday have risen some 4%, filling in the changeover gap and thus fully justifying the time crossover warning I gave. This just leaves us with what may lie ahead. Right now, it looks like the upper time is still in control, especially if prices manage to move back down below the November 2020 high at 439. However, please keep a wary eye above on the gold long moving average, currently at 452, and also I would watch the unhighlighted lower trendline extension, currently at 460, of the July 23 to January 24 descending triangle pattern, as this seems to be the center of some congestion, as we saw back in late December last year through to early January this year, as well as between March and April this year. Kansas City wheat. Since mid-February, two major patterns have developed here, one which is still live, and a third pattern that is no longer operational, but from which we have some echoes that resonate even today. The first pattern is a mid-February to late April sideways triangle, made up from the bright pink uptrend and the bright red downtrend. It's not a great looking pattern by any means, but it nevertheless still exists. And 5 weeks ago, prices pushed down below the lower trend line, whilst at the same time following on lower from a mid-March to early May bearish halfway hesitation pattern. The second pattern is a February to March bearish shift pitchfork, with prices still live within this pattern, last week testing the unhighlighted lower time, currently at 501, piercing it but reverting back upwards from the previously highlighted unreconstructed December 1999, yeah, that old December 1999 to date uptrend, currently at 504, before changeover, and this week piercing and resting on the middle time, currently at 548, as well as the March 24 low at 551. Interestingly, this week we have seen prices push up as far as the March 2021 low at 559, and especially get capped by the green short medium moving average, currently at 562. Finally, 3 weeks ago, prices broke down through the also unhighlighted lower time, currently at 549, of the significant, very shallow, late August to early December 2024 bullish shift pitchfork. But this week we have seen prices move back above it once more, and also seemingly rest upon it. Okay, so going back to the first pattern again, and the sideways triangle. I said 3 weeks ago, and I quote, "All this action has nevertheless still left us with some targets below for the sideways triangle pattern. I have a primary target X in the 522 zone, not too far away, and a secondary hardest reach target X1 down in the 471 zone. I'm not too sure about these two, but for now they will do." End of quote. The primary target X did very nicely, being achieved soon after my video back then, but the harder secondary target X1 is still open and increasingly becoming unobtainable. It was, as I said last week, and I quote, "I'm still not too sure about this lower secondary target, but as I said before, for now it will do." End of quote. I will leave this secondary target X1 still on my daily chart for at least another week or two, just in case, as we have not as yet created the conditions for a significant bullish pattern. Not just yet, though I still have my doubts about target X1 below. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.